It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where in the world you are today. My name is Patrick L. Young. The IPO-VID Livestream Series 14, Episode 4, that amounts to Episode 82, starts here. Results season is underway in the parish of exchanges and market structure with some stunning results. The mega brokers, for example, Charles Schwab and IBKR, showed how choppy markets can prove profitable, while Market Access and IBKR have made firm progress. DB1, perhaps awakening from what seems to have been a dormant decade, made a great leap forward in Q3 as well. The reemergence of the U-curve is one factor helping the hybrid derivatives markets as QE comes to an end. Meanwhile, Binance under pressure. There's a headline we keep saying, isn't it? According to the Financial Times, Binance made grossly inaccurate UK filings, according to a lawsuit filed by the joint venture partners there. And at the same time, Reuters had another episode of their epic expose on Binance, headlined How Binance's CEO and aides plotted to dodge regulators in the US and UK. Ross Delston, an independent lawyer, former banking regulator, and expert witness on anti-money laundering issues, has noted the Binance structure in the US raises questions about the degree to which the parent company is willing to comply with US laws and regulations. Are regulators happy about a market sitting in who knows where? Well, that's going to be a lesson in object opacity at the center of a global empire in the near future. RIP Ralph D'Annunzio, Wall Street chieftain, was given a send-off with a lavish obituary in the New York Times this week. Ralph D'Annunzio led the venerable securities firm Kidder Peabody, but stepped down after it was caught up in the Ivan Boesky insider trading scandal. From the perspective of the parish of exchanges, we recall Ralph D'Annunzio very, very well. He headed an industry task force that resulted in the creation in 1970 of the Securities Investor Protection Corporation, the body that protects investors against loss from failing brokers. Equally, D'Annunzio chaired the New York Stock Exchange for a one-year term in 1971. He was the last unpaid chairman of NYSE, leaving office having carried out a reorganization based on recommendations by a group headed by William Chesney Martin Jr., who had recently retired as a long-term chairman of the Federal Reserve. The changes created a newly public board of directors and a full-time chief executive. Thus, D'Annunzio was succeeded in 1972 by James J. Needham, the exchange's first full-time salaried chairman and CEO. Looking back on those storied analog days, well, it comes a couple of years later, but following on from my 40 years of life article celebrating London's financial futures exchange's anniversary, I gave a brief primer this week. You can catch it on Medium, LinkedIn, and of course earlier it was in Exchange Invest, the daily Bourse Bulletin newsletter, talking about the essential analog trading floor data gathering device. There it is, ladies and gentlemen, the trader's card upon which so much of civilization, financial market civilization at least, was dependent throughout the course of, well, all the way up to the turn of the millennium at floors across the world before digital trading took precedence. And indeed, talking about digital trading, that brings us elegantly to our guest today, Christian Katz, the topic, Securitizing the Future. Christian Katz is the CEO of Helveteq, an issuer of ESG transparent investment products, including carbon neutral exchange traded products. He's also founder and managing partner of financial consulting firm MainStrait. I'll try that again. MainStrait, and holds several board seats in the financial and technology sectors. Previously, Christian was the CEO of STOXX, Swiss exchange, vice president of Europe's largest index firm, STOXX, and president of FESE, the European Federation of Securities Exchanges. Christian began his illustrious career in investment banking, where he held leading positions at Goldman Sachs and JP Morgan. He holds a PhD in business administration from the University of St. Gallen in Switzerland and lives in Zurich, having worked in Hong Kong and London during his professional career. Christian, greetings. Welcome to the show. Where in the world are you today?
Hi, Patrick. I am in Zurich, Switzerland, as you said.
Excellent. Good. Lovely to hear from you in Switzerland. Looks like a pleasant day over there, being joined by one. And also, how long have you actually been back in Switzerland? You were in London last before you returned to Switzerland. Is that right?
That's correct. I lived and worked 10 years in London, most of the time with JP Morgan, and returned to Switzerland about 16 years ago.
Wow. 16 years. And then before that, you were in Hong Kong for a spell. I suppose Hasley said Hong Kong, I think, has changed quite a lot since you were there.
One could say that. I was at the time working in London during the 90s. That means before, during, and after the handover. And it has indeed changed quite considerably. And I guess this is also one of the topics today is the trend of globalization versus deglobalization that we're seeing in financial markets.
So talking of globalization versus deglobalization, let's take a step back. I mean, how did you get into investment banking in the first place?
That's interesting. I always had a thing for numbers and for markets, and I had the chance to work in my first job at what was then SBC, Swiss Bank Corporation, just before they bought Warburg. And I got the chance to write a PhD while working. It's a bit of an effort, obviously, but they gave me the chance to work in Zurich and in Hong Kong because my PhD was about China and the opening financial markets in China in the period started really under Deng Xiaoping. And so that was a very hot topic at the time that nobody really wrote about because, as you can imagine, Chinese exchanges in Shanghai and Shenzhen opened in the early 90s, and the market was not really covered by global banks and global media. And so there was a huge knowledge gap, and China was just opening up to what today is the second largest economy and a very large financial market that has to a considerable extent also connected itself with the outside world.
Fascinating, actually. I mean, talking about that period of time, because the first wave, as it were, which you were writing about, it ended in some senses very badly, didn't it? Because, I mean, China opened up, or at least created a huge wave of exchanges, both stock exchanges and futures exchanges and so on. And then a lot of them got forcibly closed down or merged, or at least they were certainly, all sorts of weights were hung upon them. And then the whole thing slowed down enormously by the course of the second half of the 1990s.
That's correct. But the Chinese market regulators, as well as the authorities and the major institutions, they were opening up their economy in a very prudent and, so to speak, gradual way, where they first experimented with international financial markets by issuing bonds of the central bank in Japan, actually later issued bonds in foreign currencies through the major state-owned banks, particular Bank of China. And so they were kind of touching themselves and getting close to international markets, not in a big bang, but in a gradual fashion, which corresponds with the Chinese philosophy of, checking out the stones before you cross the river. And in that sense, we can see that today, China, after joining the WTO at the beginning of the 2000s, becoming an export leader globally, but also a kind of financial market that corresponds in size and almost in flexibility and accessibility to the size of its economy. So we have to say, if we look back to 1995 versus today, China has developed a financial market that is close to being equivalent to its economic power and its economic kind of infrastructure that it has today.
And it's really fascinating. And in fact, this was a topic, the modern Chinese market, we went into in a great deal more detail with James Falk, who's the author of Financial Cold War, himself a seasoned veteran of the exchange world, having worked for several years at Hong Kong exchanges. And you can catch that, I think that was episode 73, 74, something like that of this cadre. You can catch that on anywhere, wherever you're watching this, Facebook, YouTube, or LinkedIn, you'll be able to catch the back issue there. So you went through this fascinating investment banking career. You worked in various centers, and then you went and worked for the Swiss exchange. How did that come about, Christian?
It's interesting. The Swiss exchange, just after MiFID I, which was implemented in 2007, just after MiFID I was, as any other large exchanges were in Europe, were faced with competition because MiFID I brought a unified European Union financial market about and a framework for competition within the continent. So the so-called exchange dominance, national dominance, which some would refer to as a monopoly, which sometimes it was, sometimes it wasn't, but that broke down in 2007, and there was a need to make the exchange more competitive pricing, faster trade turnaround, latency, etc. And so it was a time of very much increasing competition, and that's when I had the chance to join and kind of bring some of the experience from the investment banking side, from Goldman Sachs, from JP Morgan, into the exchange operation. And so we managed to modernize the exchange together with a great team we had, and make it what it is today, a very efficient, very transparent, and very well-functioning European marketplace.
Yes, it's incredible because, of course, with MiFID I, Switzerland was in a fascinating situation, having long been one of continental Europe's leading financial center, if not in many respects, leading center for, say, things like banking and so on, but at the same time actually sitting outside the European Union. Yet MiFID affected the entirety of the business across the length and breadth of the continent. It was a huge change, wasn't it?
Absolutely. And at the time, obviously, the UK was part of the European Union, and the Swiss exchange had a business in London, so it got automatically affected and included in the MiFID push. And the decision was clear to join the competition, because I think, as you have written many times in your books and articles, competition and free markets is one of the best things that can happen to the world and to the citizens in this world. Many countries, not just China, but many others, came out of a position of, some sort of dictatorship, closed markets, planned economies where people could not live their potential. And free markets are one of the greatest inventions to give people a possibility to live up to their potential, to be innovative, to find financing for their ideas, and then go in bigger style, for example, through exchanges to get even larger enterprises and ventures financed. And I think the arrival of competition in financial markets is something that has been hugely beneficial, a large contributor to growth over the decades, and is one of the major factors why poverty levels across the earth, across the planet, have come down over the years. Yep. This is something that maybe people don't talk about that much, but there's still a lot to do. But poverty levels have considerably decreased through the decades, and one of the factors is the power of free financial markets.
It's a fascinating point you make, actually, and it's one which is disappointing because, of course, I suppose the media is always looking for bad news, but you talk about poverty, and it's incredible how poverty has been reduced over the course of, our lifetimes, from the point where something ridiculous like 20% of the entire world's population were effectively living hand to mouth when we were born. And now we're in the point where, yes, it's still there, and there are still people who live in dreadful poverty, but actually the number of people who are not fed, the number of people who do not have a roof over their head has declined inexorably. Down to relatively small percentages. Still a lot of people in a world of 7.5 billion, but nonetheless, it's not that huge a percentage that it was, particularly during as recently as the 1960s and 1970s. It's quite incredible. Fascinating. So free markets drove you forward. Swiss exchange, you were part of effectively the revolution driving that business forward. As you say, it's a powerhouse business today, very, very capably run by Jost Gisselhoff and his team, and certainly a very, very exciting part of the financial firmament. So tell me a little bit more then about reaching Helveteq. That sounds like a fascinating endeavor.
Yes, it's I had the chance to after I handed over leadership of STOXX to my successor to have several board mandates, consulting mandates, and recently last year I joined with some business friends a firm that we founded called Helveteq, which is an issuer of financial products, an issuer, in fact, of exchange-traded products, or short ETPs, which are trackers that are 100% collateralized, 100% secured, very transparent, and can be trackers for passive exposure, like commodity, or a digital asset such as Bitcoin, and at the same time can be trackers that securitize actively managed portfolios. And so we created this firm, Helveteq, which as an issuer of financial products helps you securitize traditional assets such as equity, bond portfolios, as well as digital assets, which definitely is part of something that is going to shape the future of financial markets.
So that's really interesting. So you're creating all of these different forms of securitization vehicle, and then you're listing them on exchanges and selling them to retail and wholesale investors. Is that right?
Absolutely. So you can think of an ETP as an equivalent to an ETF, exchange traded fund, which is obviously one very, very successful long-term financial instrument to get exposure. So an ETP is like an ETF, but without a fund behind it. So there's no collective investment scheme, but actually it's a single asset or a basket or an index, and it's very flexible. Something it's a new segment, so to speak, new. At the time when we introduced it in 2010, it was a segment that was initially populated by commodity investments, because commodity investments are not always easy for retail investors to make, right? Because there's sometimes a futures based, you can't really deliver a barrel of oil to somebody if they want to have physical delivery. So it's a complex thing that you can very elegantly wrap into an exchange traded product, a one-for-one tracker certificate. And later the segment got also populated with digital assets to give exposure to cryptocurrencies effectively without having to go through all the private key difficulties, multi-signature capabilities if you're a firm, or wallet protection mechanisms, but you can basically buy a one-for-one security tracker that gives you exposure to the digital asset space, which is attractive for institutional investors on the one hand, because it's infinitely scalable. And it's also interesting for retail investors because many of the complicated technical issues are solved at an institutional grade level through the firms that are involved in the setup. and the securitization.
So really fascinating. So let's drill down into that just for a second. So obviously, as you say, yes, ETPs, they started with commodities. That was a pretty simple thing. I mean, you turned up and you said, I'm going to build an ETP that buys gold. Then presumably you specify some of the ways in which you're likely to buy or own or hold those golds, and that's simple. Now, you mentioned some of these have maybe baskets of assets or different kinds of assets. So depending on the specification of the fund, can it actually change the investments it holds and the investment mix over time?
Yes, that depends on the underlying, right? If you have a passive portfolio that's, for example, governed by an index, then the index will change over time. And so will your index tracker move with the index. If you have an actively managed portfolio, then the portfolio manager will change the allocation, will get out of some stocks, for example, or digital assets and buy some others. And you're tracking this in your instrument one for one, and you're 100% collateralized because the portfolio itself is held by an independent custodian on your behalf. So you've got a one-for-one tracker and you have a one-for-one collateral securitization.
Together. And so therefore, I mean, you mentioned the start of this conversation. I mean, we were talking about sort of globalizing and deglobalizing in one sentence. So Helveteq, give us an idea of what are the sorts of products that you've listed and created so far?
So this year, in the second quarter, we issued an ETP on Bitcoin and another one on Ethereum, with the special feature being that we made them carbon neutral. Well, now, why is that an issue? It is because, on the one hand, digital assets are something that is a megatrend, long-term, multi-year megatrend, that there will be more and more assets and securities put on the blockchain, traded on the blockchain, held on the blockchain. So that's a mega trend. At the same time, to no one's surprise, the other mega trend is that we're going through climate change. And so one mega trend is, and we might pick it up in this discussion, is that we need to make sure that we, humanity, do our utmost to limit our own impact on climate change to our disadvantage and to the disadvantage of all the other, living species on this planet. So these two mega trends are somewhat contradicting each other. The blockchain is basically a consensus mechanism driven by computer power, and the way blockchains are managed globally by a lot of computing power, data centers of sometimes tremendous proportions. And now, so to keep that system going, there's a huge energy consumption linked to it. Now, this energy consumption needs to be somewhat in proportion to the impact it has on the environment, right? And these two megatrends have been truly contradicting each other. So there's a huge demand for blockchain products, and at the same time, some criticism of the environmental impact.
So hashtag it's complicated getting us to the future. That's the one thing we can quite clearly discern here. And therefore, you bringing these two megatrends together, for instance, in this product. Now, that raises a fascinating question. Do you see the business of Helveteq being securitizing digital products, or do you see it in a whole gamut of legacy, TradFi, whatever you want to call them, as well as digital asset products?
Now, the strategy of the company has always been to be a securitization platform for all kinds of assets. So while we started with digital asset underlyings, the capabilities of the firm are to securitize also traditional assets, or a mix of both. And for that, you need a regulatory environment which allows for that. You need custodians that can take custody of shares, for example, bonds or structured products, but also can deal with custody of digital assets. And this is why we're in Switzerland, because Switzerland is very progressive in this regard, while conservatively keeping its values of safety, reliability, and transparency.
I think that's a key point. It really is a key point, and I think a lot of people do not readily appreciate that, is just how Switzerland has been eagerly in the vanguard of trying to enable a great deal of digital product, but at the same time, as you say, holding on to those traditional Swiss values, the traditional global values that we need to make markets safe and secure and well regulated. So therefore, I mean, has there been a lot of discussion that you've had to have with the varying different regulators in order to bring your products to market, or did you find it relatively smooth running given how innovative you are?
I suppose the financial industry here went through a difficult start of adoption of digital assets in around 2017-18, but now it's been relatively smooth. There are several providers that can handle it, and I'm talking about not just banks and custodians, but also auditors that understand how to integrate digital assets into P&L and balance sheet statements. So the industry has really matured in a way, and I think one of the most underappreciated facts is that unlike other countries, Switzerland did not come up with a virtual asset or virtual digital asset law framework where they defined digital assets all from scratch separately, but instead they integrated the handling of a blockchain ledger into existing legislation that is centered around centralized ledgers, right? And so they integrated it into existing laws, adapting the entire legal framework so that it could also not just integrate and deal with a centralized ledger such as the housing ledger of a particular city, the administration office, but also deal with the blockchain ledger. And I think that is something which long-term should pay off for the benefit, not just of Switzerland, but because it's such an open country and such an open financial market, to the benefit of many, many players in this world and many investors.
Yes, it's been very interesting watching the way the world has adopted, often, I think, overly prescriptive laws which have sort of dictated where the technology comes from, and even tried to regulate the technology, because I don't remember them trying to regulate, for example, the spreadsheet, which in many ways you'd think could have been regulated as a financial instrument many, many years ago. And yeah, the way that Switzerland has been very pragmatic, has been very good for all kinds of digital assets. And in fact, the way that it's said, well, if it's an artwork, therefore, and it's a commodity, if it's a physical commodity, there are various other pointers around which you can define and use classic definitions which adopt the market. Well, I agree with you. I think Switzerland has been incredibly intelligent and pragmatic in the way that it's gone about this. So that's obviously great for you, for Helveteq being based in Zurich. What about the ESG dimension? I mean, is there a lot of push in the regulatory cadre to embrace the ESG phenomenon more, such as there is, say, from the US SEC?
Well, our company was from the start very ESG focused. We are submitting ourselves to the B Lab certification, which is a certification called B Corp. That's maybe the global leader in ESG certification for companies. There are over 1,000 in Europe that are already part of it. And at the same time, we wanted to make our products ESG transparent. And clearly, whenever it's on digital assets through a cooperation with the university FinTech lab, we have made them carbon neutral in order to compensate completely for the environmental impact that the products might have through the blockchain. Now, having said that, the political push with regard to ESG compliance and transparency has really taken a big step forward in August of this year, August 2022, when the European Union implemented the requirement for financial intermediaries to ask not just the risk preferences and return preferences of investors, but also their ESG preferences. And that process is part of a larger EU agenda to achieve the climate targets, and also has absolutely given a clear signal to the world that the continent is making a big push towards that. And this has affected Switzerland as well. We are following the same path with the same objectives, and are adopting some of those measures also here. And as we said, this is a very open financial market with a lot of foreign investors holding their investments in Switzerland. And hence, the market here is always adapting to international developments in order to be cross-border compliant for the clients that actually are investing here cross-border.
Very interesting. And you've got the complete cornucopia of investors obviously coming into you, which is interesting because, of course, your products are remarkably safe. And what I mean by that is in the sense that you're 100% collateralized at all points in time. You're not entertaining leverage, if I understand correctly.
Correct. There is, products could be on a leverage basis, but we have not issued any leverage products today.
Good. Well, it's of course a possibility that you may go there in the future, but nonetheless, at the moment, you've got these interesting tracker securities, digital assets, and so on. With the ESG dimension, how do you think that's going to progress from where we are now? As you mentioned, I mean, the EU is obviously very keen to bring in its regulations, etc.
Yeah, if we just have a quick look at the EU agenda here, how ESG preferences are dealt with for investors is as follows, right? And I'm simplifying a process that is anything but simple. But in a sense, the intention is that investments are more and more made into in a sustainable fashion. So sustainable investments become the majority now. So when you have investors looking at products such as funds or ETFs, or for example, also our products, you want to know how much of their portfolio they want to have in sustainable investments. So you need to measure that. And there are several ways how investors must indicate actually, now in the EU, indicate their preferences. And you can do that via a certain catalog. It's called the EU taxonomy, where you have very specific indicators you need to fulfill and say how many percent of your investment should be according to those indicators. The second thing you can do is indicate whether you want sustainable investments in the sense of that they help sustainable investments, nurture them, or whether sustainable investments are actually the objective of what you want to do. In other words, like impact investing. That's called SFDR, Sustainable Finance Disclosure Regulation, which is category 6, 8, and 9. 6 is you don't really care. 8 is ESG compliant, and 9 is impact, to simplify. So you can indicate that. Or thirdly, investors can say how they want certain principal adverse impacts to be dealt with. So how much they put importance on clean water, on the fact that there are good working conditions for the workers who produce certain products globally. So those are things you can indicate as an investor, you must indicate. And then the financial intermediary, I'm talking about banks, about brokers, they will then select the right funds or other financial products. And frankly, our duty is to produce product. Our intention is also to produce products which are sustainable, so that we actually give solutions to those investors which demand certain quality for their investments, not just in financial performance, but also in sustainability impact.
So that's really interesting. And I mean, particularly when it comes to, say, sustainability products and so on, how do you go about trying to discern what products are likely to work in the market? I mean, I'm not looking for your secret sauce, but I'm just wondering, is it more by talking to large institutional investors, or is it by trying to find out what there is in the issuer market that you feel would make a good product? How do you go about that whole process?
I think you said it perfectly, Patrick. It's a combination of the sell side and buy side needs, right? So on the sell side, you want to issue products that meet the demand or future demand of investors. And at the same time, the buy side will indicate to you what they prefer, how much certain factors are important at this moment. And this is it. This is the free market. So you bring together the buy side with the sell side and try to get the best products out there. Not always easy, and preferences change, as we know, through global changes such as wars, such as certain supply chain inhibitions, restrictions that suddenly appear. So preferences change over time, and that's why, what we said before, that's why the financial market needs to be free and open so that it can adapt and can produce the kind of products that investors want and investors use, as well as those that take the investment and produce something.
Very interesting. And so when you're developing a product like this, Christian, and we're out there securitizing the markets worldwide, is it a very long lead time for every product? I mean, obviously there's a series of different things have to be sorted in terms of actually organizing the custody, the product, the documentation and prospectus and so on. You have to get the regulators on side, you have to get the issuer or the exchange to give you the okay and so on. So it's not the work of an afternoon, but is it a particularly long drawn out process, or can you react relatively quickly as you see market conditions changing?
That depends on the product, right? So if you're launching a fund, say in a major jurisdiction, a major country, you're launching a fund, then it's usually a long process, a costly process, and that's why you see funds really issued only from a certain size, right? Normally one would say about 50 million, whatever the currency these days, it's all the same. Swiss francs, pounds, euros, dollars, it's all around the same. So, around 50 million is usually a good size to start a fund because of the lead time and the cost it entails. Now, other products such as, what we deal with, exchange traded products or ETPs as we call them, they have a much shorter lead time and therefore they're also much more cost efficient to issue, and that's really a sweet spot, and that's one of the advantages of using such a structure is speed and cost, and speed is time to market.
Right, and speed is time to market, but then also presumably there's a great advantage because you are exchange traded, so then it becomes incredibly easy in terms of custodians and other parties obviously can settle it very easily because it's going through the Swiss exchange or whatever.
Correct. And what we also found is that certain clients, certain banks, for example, don't want necessarily their products to be listed on exchange. They like the setup. They like to have a 100% tracker that's 100% secure and 100% collateralized all the time. They love the concept, but they say we have our own e-banking market, we have our own OTC network of distribution, so we don't want it exchange listed. And that's why we created the same structure without exchange listing, what we call non-exchange traded products, or ETPs, is exactly the same thing as an ETP, just without the listing. Has certain advantages. You have a bit more flexibility with regard to the underlying, and less cost to maintain the listing, while you don't necessarily have exactly the same full liquidity benefits that you have from an exchange listing. So try to cater to both sides of the market.
That's a very interesting concept altogether. And of course, there are also, I suppose, certain venues around which effectively allow you to list up front, but then don't have their own secondary markets. I could think of, well, for example, the Gibraltar Stock Exchange being one of them, where you can bring these sorts of products, list them, and then ultimately take them off to the issuer can take them and trade them how they wish to in the chosen secondary market, which can even be private and internalized within their bank or within their MTF or something. It's a very, very interesting strategy altogether. So you're sitting here at the intersection of digital and legacy TradFi assets. What do you think is going to be the next series of steps in terms of, are these two universes going to stay entirely separate, or do you think there's going to be some sort of a crossing where they're going to come closer together over time?
I genuinely believe that the benefits of a distributed ledger, it's basically, it can't overrate it either, right? It's like an open database that where all the participants are at the same level at all stage, versus the traditional financial system, which is based around central institutions of trust. That I believe that there is a cohabitation forming, and that there are certain parts of the financial markets that are better served by open, decentralized systems. And then there are indeed certain pockets of the financial markets which are better dominated is maybe the wrong word, that are better handled, governed by trusted centralized institutions, or what somebody would refer to as centralized ledgers. So I think there's a cohabitation forming, but that cohabitation has been relatively difficult to form because one side was kind of afraid of the other, and this cohabitation is probably not producing the benefits yet that it can produce in the future.
So you mention a great deal about obviously the relative advantages in particular places of distributed ledger, and also the use of centralized ledgers in their own particular environments where they can be best. In terms of Helveteq, have you represented a significant leap forward in terms of the technology you're deploying to bring these sorts of products to market?
I think what we're trying to do is we try to kind of bring these two worlds together. So, if you think of banks or pension funds or asset management firms, they have their own accounting systems, their reporting systems, their portfolio management tools, their risk management tools. And sometimes these are not really adapted to deal with, for example, blockchain assets, right? So by taking blockchain assets and securitizing them, they are immediately bankable assets, are integrated, equivalent to shares, exchange traded funds. And they can, in this sense, we make the bridge between those two. But at the same time, this is not all we do. We as we said before, we're also securitizing other portfolios, traditional portfolios with traditional instruments. And that's where we make a bridge and make things more easily investable, but in the traditional asset space.
So therefore, by utilizing your technology, that therefore makes it much easier for you to facilitate through the various kind of traditional distribution methods through the exchanges and the existing clearing, settlement architecture, and so on. There's the possibility there. What do you think are the limits to securitization, or indeed are there any?
Yes, I think there are always limits to everything, but securitization is one way of pooling, so to speak, pooling ideas, pooling investments, and making them accessible to a wide range of investors, be that institutions or private investors. So securitization is not a panacea for everything, but what it is, it does make things accessible and tradable and transparent. And I think that's what we should have in financial markets is transparent products that are regulated, where you have a basis prospectus explaining everything transparently, available to everybody. This is where we can grow the participation of investors in the markets, and that is something that securitization can bring.
So in that sense, you definitely can, Christian Katz, look at securitizing the future, and there's a huge panoply of possible assets out there that you're looking at. Are there any particularly interesting things that you're looking at or bringing to market in the near future?
Yes, we're in the process of securitizing traditional portfolios in the equity space on futures. We're looking at real estate securitization, when the underlyings could be real estate or securities on real estate, and we're definitely also looking at the precious metal markets, and there again, I think we have to focus and be responsible and look at sustainable precious metals that are also carbon neutral, because there again, this needs to be done in a sustainable fashion, and so we need to manufacture products that live up to that.
That's very, very interesting indeed. So therefore, just picking, a few of those things. So the sustainability factor and the carbon neutrality of things like metals and other extractive resources is obviously a very technical and interesting process. And presumably that also then lends you into the broader ESG impact where, for example, we know that there are issues with pollution that take place when you have extractive industries, potentially if they're not properly managed and so on. Are you looking to go all the way along that chain in order to provide essentially as clean a metal as possible, not just carbon neutral?
Yes, I cannot promise what our next product will be, because I don't want to leap forward too quickly before we actually launch them. But yes, when we do, we like to be looking at the chain in a holistic fashion. And when we talk of environmental, social, governance issues, we like to think of it in a holistic way.
And certainly, at the bricks and mortar level, it's fascinating what you're talking about here, because of course, securitizing property and real estate is nothing new. The single asset property company, well, the first one of those I think was listed in the London Stock Exchange in the mid 1980s, if I remember correctly. But nonetheless, these days, it seems to be an idea whose time has come in many respects, whether it's going to be a single property or a portfolio of property, because obviously it allows people to get fractionalized interest and also makes it much, much easier to buy and sell than it does in a world of stamp duties and complex paperwork, etc.
Yes, I think you're right on that.
So fascinating altogether to look at the vast panoply of possibilities that you've got, which range from essentially relatively conventional securities-based portfolios, crypto-based portfolios, the future digital asset-based portfolios, etc. And obviously giving those an ESG and a carbon neutral tinge all the way through becomes a very, very interesting process. How do you manage to affect the management of these assets within Helveteq? To start with, is Helveteq a particularly large team?
No, not at all. We're trying to look. We're a young company. We've been in business a bit more than a year, and we are between half a dozen and a dozen people, and the business is scalable. We try to be a very effective platform and efficient platform. So the setup is not necessarily dependent upon a very, very large team. It's dependent upon investors that are looking for our products, and that we manage to get the right products out there.
And you mentioned at the very start of this whole discussion about securitizing the future, Christian, the idea of, well, you talked about the world of globalization and deglobalization simultaneously. So where does Helveteq sit in that nexus between the 2 points?
Oh, we're definitely pushing global access to our products, transparency, and making them available. That's why we also like exchange listings per se, right? Making them available to everybody, transparent pricings, transparent regulation. Everything is really available for everybody at all time, and that's definitely where we are pushing and trying to get products out that are interesting, not just for a cluster of investors, but for the broad market.
And so therefore going forward, well, in fact, right now, if I'm correct, you've listed all of your products so far in Switzerland?
That's correct. We have plans to go outside Switzerland, but that's something that we're looking at next year.
Very interesting. And is the idea then to take the same products that you have at the moment and list those elsewhere, or are there going to be specific regional or special products that you're looking at trying to bring to different markets across the world?
We'll look at that next year, but it should be a combination of both.
Okay, very interesting altogether. So therefore, as you look going forward, you're obviously in this business of trying to provide global access for investors around the world. What has been the kind of mix that you're getting at the moment in terms of the investor base into your products?
I would say it's relatively balanced. Most here, clientele in this country, unlike exchange traded products, generally is almost half of the original investors are based outside the country, and but they might interact, they might buy through a foreign firm or even a domestic firm, but the ultimate owners, beneficial owners, so to speak, are very often outside the country. So it's not a particularly domestic and not an exclusively global product either. It's really a mix of both.
And what about the mix between, say, for example, institutional investors and retail investors?
Again, it's a mix of both. It's a mix of both. We had initial investors of obviously also, people from our close environment, and now I think the market in general has been obviously difficult in the last few months. One has to say it's not on anything. It's not easy to grow financial products from the start to a very big size in the last few months, because equity markets, bond markets, digital asset markets have been under pressure, even in some places, real estate markets. So I think it's an environment where for many investors it's been difficult, and so we see as a product issuer, obviously we also see the demand fluctuating with market conditions, and so we're looking to see in the future how the mix is going to develop.
Very interesting altogether, Christian. So we've been discussing securitizing the future with Christian Katz today. And I suppose that brings us really to the question that we always end the show with. Christian, where do you think the capital market revolution goes next?
That's a very good question, Patrick. I'm always fascinated when you ask them at the end of your interviews. I believe that we will see that the financial markets will follow somewhat the deglobalization we find on the political side today.
And on that very wise note, ladies and gentlemen, we've been discussing securitizing the future with the CEO of Helveteq. It's essentially a startup, just a one-year-old business, but it's producing already some fascinating exchange-traded products and indeed non-exchange-traded products. Neat. The whole new word and acronym for the day, just when you thought probably there couldn't be another acronym in financial services or financial markets. It's been a pleasure chatting to Christian Katz. I really, really appreciate your time, Christian. It's very interesting on this globalization, deglobalization nexus, looking at the different ways that the potential products can be, and all the time taking that lens of looking through the whole ESG environment. And indeed, you brought us to our attention today things such as the SFDR, the Sustainability Related Financial Disclosure Regulation, which I think many people probably thought wasn't going to be something that was going to be included necessarily this quickly directly into fund or structured style products, such as your own exchange traded products. Ladies and gentlemen, it only remains for me, Patrick L. Young, to say thank you very, very much to Christian for today's excellent show. I also want to bring you to your attention. Next week, we'll be back live with BMLL Liquidity Maps, the Data Magna Carta. That's the question we're going to be raising with Dr. Elliot Banks and Paul Humphrey. Paul Humphrey, of course, previously been on this show. Dr. Elliot Banks is going to be a magnificent addition to the IPO-VID alumni. And ladies and gentlemen, my name is Patrick L. Young. It remains for me just this evening to say thank you once again, Dr. Christian Katz, for your excellent presence on this show. We wish Helveteq all the very great success in the future. Thanks to our production team, Racy, Marianne, Janella. You have been magnificent today in the course of this show. Thanks to Beata. My name is Patrick L. Young. I wish you all a great week in blockchain life and markets. And if this broadcast hasn't been enough for you, check out our old issues, our previous episodes via YouTube, LinkedIn, or Facebook, wherever you watch this show, searching for IPO-VID. And don't forget the business of bourses, discussed every day in the Exchange of Information, the Exchange Invest newsletter. Hit us up with a DM if you'd like to be added to the subscriber list. Christian, thank you very much.